Good afternoon, everyone, and welcome to our special IBD webinar on psychological market indicators. My name is Jonathan Howard. I'll be your host today. In an effort to make Investors.com, an ongoing effort to make Investors.com the best financial website out there, we've recently added an entire section on psychological market indicators. So this afternoon, we're going to discuss them and how they can help you identify the market trend. But before we get started, I'd like to hear a word from our sponsor, Simpler Options. Mr. John Carter is their founder and CEO, and he's going to talk to us today about identifying and trading major reversals. Good afternoon, John.
Jonathan, thank you very much for having me. I'm always been a big fan of IBD for a long time, and very excited just to spend a few minutes just talking about identifying and trading major reversals, where psychology really comes into play. So it's really important to kind of get a handle on that psychology. So we can hop on to the next slide here. For those of you that, I guess, never heard of me, which I think there's a lot of people that haven't, so which is fine. I've been doing this for about 25 years. I got my start in the 90s taking classes with Investors Business Daily. And so I've always been a fan of their work. And I've just kind of taken that and really taken the ball and run and using a lot of their tools, but using options, whether it's options for income or buying and selling calls and puts. In 2005 and then again in 2012, there was a book released of the strategies that I talk about called Mastering the Trade. And, again, it's just kind of documenting my trading journey and just finding what's worked for me. And I think it's just very, very important for everybody to find the best trading and investment strategies that work for them based on their own internal risk profiles. And we can hop on to the next slide. And what I'm interested in today, and I'll be watching this webinar along with you guys and gals, is that timing reversals using specific indicators, specifically psychological indicators, is really one of my favorite ways to trade. At the end of the day, the herd mentality, okay, when it reaches extremes, extreme pessimism or extreme optimism, is actually very easy to identify with key market psychology readings. And so anytime the herd gets too crowded on one side of the market, if everybody's long Apple and no one else is left to buy Apple, guess what? Apple goes down. And it just means a huge reversal is about to take shape. But you need to be able to identify that or you're going to get left holding the bag. So the key is understanding how to read the indicators and, more importantly, how to initiate trades once these indicators reach their trigger point. Okay, we can go to the next slide. So the idea with this, especially with options, is that you need to be able to time the move, okay? And timing the move really happens if you get a handle on the psychological indicators. Otherwise, a lot of times you're going to be in way too early or you're going to be in way too late. And then the other part of the equation is to use the right options. If you don't really understand how the options market works, you can get into a reversal and completely miss the move because you bought the wrong option at the wrong price, okay? And we can go to the next slide. And at the end of the day, if you time these correctly, they can turn out to be some of your best trades, especially with options. There's a saying that I really like from Paul Tudor Jones. He's one of my favorite traders. And he says that I believe the very best money is made at the market turns. Everyone says you get killed trying to pick tops and bottoms, and you make all your money by playing the trend in the middle. Well, for 12 years, I've been missing the meat in the middle, but I have made a lot of money at the tops and the bottoms. And I think it's a really important quote, and we can go to the next slide, because a lot of times the easy trade is actually playing the trend, okay? The trend is your friend, so to speak. But what happens is a lot of times people play the trend, but they completely get blindsided when the reversals happen. So if you can identify the psychological kind of tricks of the trade and the indicators that are about to say, hey, guess what, a reversal is about to happen, well, first of all, you can get out of your long positions, but secondly, you can set up positions using options to benefit from that downside move. So I've been options trading for over 25 years. I've learned everything that I've learned through the School of Hard Knocks. Reversals in the market offer really great opportunities for trading for those that know how to identify them and get positioned for them. I'm going to be doing a free webinar on this topic next week. And if this is something that you're interested in and you want to see how to use options to time reversals, whether it's in the stock market or even in, you can use currency ETFs like the euro or the dollar or gold or oil or even bonds. There's going to be a huge reversal in bonds at some point in the near future because of interest rates. And those are moves that you can catch with options. So here's the link at the bottom of the slide. This free webinar is going to take place on Tuesday, September 6th at 7 o'clock Central Time, which is 8 o'clock East Coast Time. Space is limited, but you guys are getting the first shot at this. So if you sign up tonight, you should be able to get in. And the link is simplertrading.com/hunting. So just simplertrading.com/hunting. It's a free webinar, and we'll show you kind of all the different psychological things that we use to catch this. So that's what I got. You guys have a great webinar. Thank you, IBD, for having me on. Always a pleasure, and I look forward to the presentation tonight. Jonathan, I'll hand it back over to you.
Thanks so much, John. All right, let's go to our active webinar agenda. We're going to talk about what these indicators, what psychological indicators are, where we can find them, and how they can help us determine the direction. So I want to introduce our two speakers. We have Mr. Chris Gessel, who's our Chief Content Officer, and Mr. Justin Nielsen, who's our Market Research Director. Welcome, gentlemen.
Thank you.
So let's get started. Let's talk about trading psychology.
Well, basically, the biggest thing that individuals have to combat in their road to success in investing is emotions. And the fact is, it's not true of just individuals, but it's actually true of the whole market as a whole. Mass psychology, can be emotional. That works against you. Professionals, hey, they're human too. They succumb to the same emotions. And so what we look for is those elements of mass psychology that show extreme levels of either fear or overconfidence that can help us kind of determine that the market might be at one of those inflection points and be turning the other direction. So as Jonathan mentioned, we now have a special page for psychological market indicators that we've added onto investors.com to really help our subscribers gauge this market sentiment. And before we continue, I just want to make sure it's very clear that the way we use these indicators is as secondary indicators. We are always using price and volume action as our primary indicators. That's going back to the follow-through days, distribution days, the things that you read about in the big picture. Those are always our primary indicators, and it's the psychological market indicators kind of help us frame that in the environment that we're in. Are we in an environment where it's time to start looking for that price action that will show us a reversal? And more importantly, you're using the chart action to confirm maybe what you're seeing in these psychological market indicators.
And also, it tells you how aggressive you might want to be
absolutely.
at a turn.
Yeah, there's a big difference when you see the fear levels hitting a very high level, where it kind of says, oh, you know what? If I get a little bit more aggressive on this round, it might pay off in a bigger way.
Absolutely.
So, Chris, where can we find these?
Well, the first thing you do is go to the home page of Investors Business Daily Online, investors.com, and go to the market trend, hover over that, and up comes the secondary nav, and you'll click on psychological market indicators. And that takes you to this landing page where we have a number of indicators. And let's go to the details. Now, all these, when you click on these indicators, it'll take you to a page devoted to them with details on what the indicator is, how it's used, why it's important. And the first three here are probably pretty familiar to our long-time readers. The CBO Market Volatility Index, the VIX, the put-call ratio has been on the market charts page for years, and then bulls versus bears has been in the paper for as long as I've worked at IBD, and that's a long, long time. Now, the last two, the high-low ratio, is a proprietary, brand-new indicator that we've developed, and then margin debt is maybe new to IBD. It's been out for a while, and actually something that if you've been to level 4, I've often showed it as one of the things that I look at and judge the market. So let's begin with the market volatility.
Okay, well, as Chris said, this is often referred to as the VIX. what it's tracking is, it's called the CBOE, Market Volatility of the S&P 500. And what it's doing is it's getting a sentiment, it's used as a sentiment indicator that helps determine major market bottoms, intermediate bottoms, as well as short-term swings. And the reason why it's called the VIX, that's just kind of short for the volatility index. And what they do is they basically calculate option prices on the S&P 500. And as you see rising premium in the option prices, that lets you know that there's more uncertainty or more implied volatility, that they expect a bigger move one way or the other in the index. So you have to think of this in the opposite way. A rise in the VIX suggests that there's elevated levels of fear. So that's also why it's called the fear index. So, higher levels are kind of, meaning that you're closer to a bottom a lot of times. It's usually what happens when it gets to those high levels. The market is usually taking a severe plunge sometimes in some of those cases. So as mentioned, this is something that we've used for a very long time on the monthly chart to identify some of these long-term market bottoms, but we've been using it a little bit more frequently on the short term. So let's go ahead and take a look at how we've been doing that.
All right. So for years, when we would look at the VIX internally, and let's say I was writing the big picture and checking all the market indicators, I would call up the monthly chart. And the level that I would focus in on is right over there, 45. So when the index would spike above 45, often we would be near a market bottom at that point. So let's take a look at the most recent, or actually 2011. Here's a good example. So this was during the market sell-off that was being triggered by fears of a global recession, and the market really broke hard in August. And in fact, this is a monthly chart, so the high, it's saying 831, but it actually, when it hit that spike at 48, I think it was around early August, 8/8 or so, August 8th, and the next day the market reversed. And that, for the next 2 months, was the market low as it bounced up and down. So, and from there, the market eventually went higher. Now let's look at the most recent example of this, and that occurred in 2015, and that was during the mini flash crash. And again, the very high spike on this was on 8/24, and the intraday low occurred that very same day. And from there, the market started working higher. Now we had another retest of the low about a month later, and then it turned around. But again, this can be, some of the other indicators kind of get you in the ballpark. This one often hits an extreme level on the very day or maybe the day before when the market is hitting a new low. So while we have often used this to look at intermediate or long-term market bottoms, we've also started using the VIX to look for shorter-term bottoms.
So here's a daily chart of the VIX, and the way that we're using this on the daily chart is a little bit different. Instead of looking for a particular level, what we're using is the 10-day moving average, which you can see is the green line on this chart, and we're looking to see when it gets extended, when the VIX gets extended from that line. The level that we're usually looking for is around 20%, and that's what these arrows, these red arrows, and these are going to be noted on the charts that you're looking at on the web. It shows when the level gets above that 20% above the 10-day line.
And just to note, that's when it first kicks in, but
right.
Actually it can go a whole lot more than 20%. And generally, if you're really trying to get the timing right, a lot of times when it hits 40% or higher, that's when you're going to get the actual reversal.
And sometimes that reversal is happening as the VIX eases off that high. You start seeing the VIX, and a lot of times what happens is that spike kind of happens, and then it comes down pretty quickly, as people kind of relax a little bit. In fact, why don't we go ahead and, you can hover over, you can use the track price by clicking on any of the prices, and it'll show you exactly what was occurring on that particular day. So right now we're looking at June 27th, which you may remember was right after the Brexit vote. The Brexit vote happened on the 24th. It didn't really go the way people had thought it was going to go, and a lot of people were surprised, including, I think, some of those that voted for Brexit, But, what happened is at the highest level, it got to 30.79% above its 10-day. So that's showing us, an extreme level, and the 27th was really the bottom. This is something that we used, Chris and I, for the Swing Trader product as we were looking to add names to Swing Trader because it's a shorter time frame. Immediately on June 28th, we were able to start adding names because we saw this indicator.
And because we were also seeing this spike in fear, that's what also gave us confidence when we had the third-day follow-through later in the week to go ahead and pull the trigger there.
And so we've overlaid the S&P 500 index on the top there, so you can really see how a lot of these arrows, these spikes in the VIX, correspond to bottoms in the S&P 500.
And even very short-term bottoms. It might be a 2 or 3, 4, 5% correction.
Right.
Let's move on to the put-call ratio.
Okay, well, put-call is another one of our long-term and favored psychological indicators. Now, and right now it's on the market charts page every day. Now, it's a contrarian sentiment indicator, and it originally we used it more for major market bottoms, but it's actually become useful for not only major market bottoms, but also these short-term corrections. It might be like 5 to 10%. Now, the put-call volume ratio measures option activity. It's taking the number of puts, dividing it by the number of calls. And remember, puts are typically bearish. When you buy a put, you're expecting the underlying stock or the index to go lower. When you buy a call, you're bullish. You're expecting the stock or index to go higher. And so when the put-call ratio spikes up, what it's telling us, there's a lot more puts than calls. It means people overall are feeling bearish about the market. And like Justin was saying, mass psychology does exactly the opposite. When the crowd is going one way, the market goes the other. And that's why you need to train yourself. And it's very hard to, even now, we've used this so many times, and we'll see a reading, and people say, yeah, but the market's doing this. It's like, wait, let's think about this. This is telling us that the market is turning, and as uncomfortable as we may feel because we're suffering from these same emotions, you need to act, or at least look for something happening in the market. So let's take a look at the most recent example, and actually the critical element or level, the trigger level that we're looking for is 1.15. And so that means we've got well more puts than calls. It doesn't happen real often. And the most recent example, again, was during Brexit, and this happened on 6/27. So that was the Monday after the Thursday vote. The market sold off on Friday and Monday, and it really spiked up to 1.21. So clearly, 20% more puts than calls on that day. And again, like we said, we in this case we had two indicators flashing. We had the VIX and the put call, and that's again why the next day we started adding names to Swing Trader, and later in the week when we got the third day follow through, we didn't dismiss it. We said this is a time when we're going to give it a go, and it turned out to be a good call.
We're kind of looking for a reason to
get
back in. You know what, just to, real quickly, just to mention that people can be asking questions, and we're going to get to as many of these questions as we can, but John had a pretty good question here. He was asking which indicators are the best to use to time the market, and as you've kind of seen, just with these two, sometimes you'll get multiple indicators triggering at the same time, and that might actually give us a little bit of extra conviction. These fear levels or, these sentiment indicators have really gotten to extremes when it's clicking off more than one.
But by the same token, they're secondary indicators.
Yeah.
They don't always work.
Right.
And that's why we have a number of them, because they're, for whatever reason, sometimes the volatility index might trigger and the VIX does not, or something else might show something. So again, we're looking at this, we're trying to get a sense of what's happening in the market and then act accordingly. And again, remember, just because this indicator goes above the 1.15 level doesn't mean you turn around and necessarily load up on the, on calls in the market or buy that big triple Q position that I'm always dreaming of. It just says, okay, I'm changing my mindset. I'm going to look at the market now. I'm going to look at the S&P, the NASDAQ. If I see a reversal, I'm going to act on it. If I see a follow-through, I'm going to act on it. And maybe in the case of when you've got multiple indicators, maybe you're going to be a little more aggressive than you might feel otherwise.
Yeah, it's almost to remind you to look for those opportunities on the other side.
Exactly.
Okay, bulls versus bears. This is another thing that we've had in the paper for a very long time on our general markets page. So we're just kind of, putting all of this stuff into one place for you to really be able to identify these easily. The bulls versus bears, this actually came from the Investors Intelligence Survey of market newsletter writers. So the idea behind its creation was, let's look at what the professionals are doing. The people that are, the experts and that are writing the market letters, let's find out what direction they believe the market's going to go into and, give that information to our subscribers. Well, Investors Intelligence was kind of surprised to find that, professionals, I guess, are human too, and they're susceptible to the same emotions that we all are. And as they tended to get more on the, to collectively agree, they tended to be more collectively wrong. So it's again a very contrarian indicator. So as you see more bears, that's actually a bullish thing, and as you see more bulls, that's actually a bearish thing. So let's go ahead and take a look at how we would use this is in signaling, helping us signal bottoms, and realizing that it's helping us determine when there is more fear among the professional market newsletter writers. And you see that the green is the bears because, again, it's contrarian. When you have more bears, that's actually bullish for the market. And the bulls are in red. That's because the more bulls you have, it's bearish for the market. And what we're really looking for is when you see the bears cross above the bulls. And that's what the arrows on the chart will show you. Now, this isn't going to necessarily time it to the day. You see that it crossed above that level, and then it kind of kept on going, in both of these cases. Mm-hmm. So what you're looking for is, again, it's just getting you in that mindset that a turn may be, just around the corner. And so you should be looking for those opportunities to look for a follow-through day or, get back into the market.
But the thing to remember is this one does not trigger that often. And when it triggers, it's definitely something to take note of and to be on the lookout. And when you get a follow-through after that, you can be, more aggressive. Mm-hmm.
So I think in this case, the second arrow, that was right around January, where the bears crossed above the bulls, but you see it continued going higher, and where it peaked, where the level of bears peaked.
Around 40.
Yeah, around 40. That was the exact week of the follow-through day in February. So that's the way we're using this one.
So let's move to the high-low ratio, and this is a new one. It's proprietary that we developed here at IBD, and it came out of a discussion of looking at new highs and new lows, which we have a tally every day, and we noticed that sometimes when there's very few new highs and a lot of new lows, that often happens around a market bottom. But just looking at the raw numbers never really gave us any sort of trigger levels, because in one market cycle, you may have a lot more stocks than in another, or just the nature of how that correction is unfolding. So what we did is we tally the highs and lows each day, divide the highs by the lows, and create this ratio, and then we smooth it out a little bit, and we track it every day. Now, when we get a low number, and remember what that's telling us is we're getting very few highs and a lot of lows. And so it actually drops to under 0.5. Then when we reach that level, now we start looking for a one-day uptick in that ratio. And then that's confirming that. All of a sudden the market had been, getting worse each day. More new lows than new highs, and then it just started changing. Even a fraction where you get enough new highs that the ratio starts to rise, that's when you can often see a turn in the market. And again, this is best suited for medium to short-term bottoms. It's not really that useful in long-term bottoms. So we have different types of indicators for different markets. So let's take a look at the chart. And going back to our critical level, and there it is, 0.5, that green line. And when the blue line goes below the green line, and then you look for an uptick, and again, this is automatically generated on the chart. Those red arrows will appear. And it first, in the most recent example, it flagged around the first low in the January sell-off, and then you saw again where it went down and then ticked up in February, although because it didn't go back above 0.5, it didn't get an arrow. So that's kind of the internal logic of what was going on there. But
well, and
look at it in the same way.
And another thing, I was reading some of our notes, and I know one of the things that you wrote about actually in the description was that the 0.1 level can be very useful when the market is below the 200-day moving average.
Right.
Where, and that's what was occurring there in January. So a lower threshold, may have been in play at that point.
That's a good point. Now, these different ratios and indicators will go in and out of fashion. Right now, we haven't had any prolonged, long sell-offs, but in earlier years, we've seen this ratio go lower, 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 and then all of a sudden it turns higher, and it's usually right around the bottom, which is why we generated it and started tracking it. So the other thing to note is you see how that line comes up, and when it hits the 2 level, it goes sideways, it goes flat. The ratio can go much higher than 2, but it's not really useful once it goes above that level. It doesn't flag market tops, and therefore we just cut it off and made this chart a little easier to look, because really what matters is the lows, not the highs. So that's why there's that sideways line right there. So this is brand new, and obviously right now we're not near any sort of critical level, of course, because we're not in a correction. We're in a very tight sideways market.
And even with Brexit, when that happened, that was too short to really register that much of an impact on this ratio.
Yeah, it's barely a blip on the chart.
Right.
And our last one is margin debt.
So margin debt is, again, another contrarian sentiment indicator, and this is really used for long-term major market tops, which is a reason why we really liked using this, because it's a little bit more difficult to find things that can flag tops well. And this is something that doesn't flag often, but when it does, it's something that's worth paying attention to.
Because out of the last, 45 years or so, it's triggered 4 times, and 3 of those were at the beginning of major bear markets.
Yes, absolutely. So what margin debt is looking at is, of course, for those that don't know, the use of margin is basically when your broker allows you to borrow money to trade more stocks. So if you have a $100,000 account, they might let you borrow $100,000 using your stock as collateral, and you have $200,000 worth of buying power. Well, what the margin debt, they track how much of this brokerage activity is happening, how much margin debt is being used, and the higher that level gets, the more there is a potential for people being overconfident and an absence of fear. Now, we don't look at just the level of margin debt, because then you don't have a good way of normalizing it. In the 70s, of course, it's the amount of money due to inflation and everything like that was much lower. And the size of the market and everything. So what we're going to be using is a percentage increase. We're looking at the same month of the prior year and comparing, and that way we're normalizing and getting that percentage increase. And that lets us know when we get to the 55% level, again, doesn't mean that it is the top, but it means start looking for topping action, because the amount of borrowing has gotten to a level that is, potentially unsustainable. So the last time that we saw this flag, and this is what the chart looks like on on the web, you can see our critical level is that 55. That's where the red line is. And the last time this hit was in 2007. I think it hit around June or July of 2007 when it got to a level of around 68%. The last time, yeah.
It's delayed because
right.
It takes about 6 weeks or so for the exchange to compile the data.
Mm-hmm.
So, that information became available probably in August.
Right. And so that delay doesn't really hurt you because it takes some time, to kind of start unwinding, that excessive level of overconfidence. What's interesting is I was looking back at the indicator, and one of the highest levels that we reached, of course, was 78%. Big surprise when that was March of 2000. So 78% of an increase in the margin debt over the prior year. That kind of lets you know. And it's not like 99 wasn't a year with a lot of margin debt as well. I mean, it had increased in 99 and gotten even higher in 2000.
And I think it crossed that 55 threshold before it peaked at
it did.
78.
Yeah, so it crossed the 55% threshold, and it continued up for a number of months, but 78% was the peak in March 2000. So again, you wouldn't have acted, as soon as it crossed 55%. You would have looked, okay, now it's time for me to look at my charts. Am I seeing climax tops? Am I seeing evidence that the market is topping? It lets you know to be on guard for it.
All right, we've got a lot of questions, but before we get to them, we do want to talk about a special offer we have available. These 5 indicators that we've shown you today are available on Investors.com as a username and password feature. And the Investors.com is chock full of very valuable resources and stock lists to find great ideas. And our offer today for webinar attendees is 3 months of Investors.com, what we call the IBD Digital, for only $30, which is a $50 savings. So 3 months of the IBD Digital for only $30. If you're interested, go to our offer at www.investors.com/webinar offer. That's investors.com/webinar offer. And one other quick point. Earlier when the simpler options gentleman was on, Mr. John Cotter, he offered you that webcast. Do not put in www before. A lot of people were having concerns with that. They couldn't quite get in. So if you remove the www, you are good to go.
Okay, let's go ahead and take some questions. One of them, I hope that we've answered this, but it's worth clarifying. A question that we got was, how do we interpret the not so high VIX during the correction that we had in June? Given the severity of given the severity of the decline, the person was waiting for a higher VIX level to get invested, and it never reached that level. So here again, this is why we're using that daily chart, and rather than using that level of 45, we're using how far extended it is above the 10-day moving average. And that's what lets us know, hey, this is getting to an extended level relative to where it's been lately, and that gives us something actionable.
Here's a good one from Tammy. Is the high-low ratio tracking the 52-week highs or lows, or the stocks up or down for that day?
The 52-week highs and lows.
Mm-hmm.
And then it's smoothed out a bit, and like we said, when you get a lot more lows and that ratio plunges below 0.5, that's when you want to be on the lookout for an uptick and then a reversal or a follow-through in the market.
Here's a great question. I really enjoy questions like this because it makes you stop and think. If over time people become more aware of these market indicators, does the value of them change? Is the market smarter today than, say, 30 years ago? And all I can tell you is people just don't learn. I mean, they just, emotions are emotions. We're humans, and we don't change that quickly. And as much as it would. And the reason why I kind of, laugh at this is because I still struggle. I will see these indicators and still, have to do everything in my power to remember how important these indicators can be and to get myself in that mindset. It's not easy to do, to fight those emotions.
Right. I've been using them for 20 years, ever since I started at IBD, and the VIX and the put call were the first two that that really resonated with me, and they work then and they work now.
A follow-up that this person had, which again is very, very useful. How do you determine that the indicator didn't work, and how do you act in that case? And this is where it's price and volume. That's why we look at the chart.
And having good money management rules, and you know, if you're making a play on a market index or buying a stock, that's why we have stop loss rules. We don't want to get too invested too quickly.
Right.
So it's all it's all the basics. It's doing what's right. And if the market is telling you you're wrong, you don't want to stand by and say, but the market, the psychological indicators.
I got my indicator.
Yeah, exactly.
So, and that's why we don't plunge. We don't plunge. We let the market tell us that we're right, and that's what allows us to put more money to work.
Right.
Bob asked, can you show us how to access these indicators? He might have arrived a little bit late, so we'll show you. You go to the home page of investors.com, click on the market trend, or hover over it. It'll give you the psychological market indicators. Click on that. Boom. So you're basically one click away from all the indicators being right there. And they'll give you a description. If you didn't catch all of this, what the gentleman talked about was fairly high level. There is a great description of what everyone does, every indicator does, and how to use it on the website. So click on it. They'll give you a nice description on the website. Also, there's a great article that Justin wrote last week on market indicators. So you can go to enter ticker symbol and type in the keyword, type in market indicators. It'll pop right up.
Oh, you know what? I was just reading something that requires clarification. Someone asked how the margin debt can go below zero, and looking at the chart,
it's the
percentage. So you can have a negative percentage, and that's where we're at right now. That if you compare the margin debt of the last month that's available, which is June, I believe. It's probably July is probably about to come out. But if you compare June of 2016 to June of 2015, that level of margin debt is down 11%. So it's not that margin debt went zero, it's that the percentage year over year went zero.
I think that's all the time we have. Do you have any final thoughts?
Well, there is one final thought, and a lot of people are asking, well, what are the indicators for market tops? So we did talk about margin debt, and those are the market tops that really, really matter. And like I said, it's caught the last three major bear markets, 73, 74, the 2000 bear market, and 2007. It did flip off in the mid to late 80s.
Yeah.
It turned out to be
like 83, 84, I think, somewhere in there.
Like an intermediate correction, so it wasn't that big. But it's really something that, if you're just, when you start getting out the calculator and you say, if I can continue making money at this pace, I'm going to retire by next year, you're probably near, it might be time. That's the other indicator.
That's a psychological market indicator. When you start, writing your letter to your boss.
Got a few things to tell you.
Right.
But I will say there are, it's always a struggle to find shorter-term indicators, and we're always looking. In fact, we've got one that's in the works, and there's also a licensing issue that we need to get. So this page is not done. It will continue to grow and evolve, and as we find new indicators and new data comes up. So if anyone has suggestions, we're happy to do it. We'll do the research and dig in.
Investors.com is always in beta. We're always developing new things, so stay tuned. And on that note, thank you very much for participating in this webcast. It will be archived in probably the next 24 hours, so if you missed part of it, please come back to Investors.com, and the webcast will be archived. Thank you for your time.
Thank you.